You may be surprised to hear this, but right now, the Federal Reserve owns a smaller chunk of the national debt on its balance sheet than it did 5 years ago and even 10 years ago. Now, that might be surprising considering the fact that this is what the Federal Reserve's balance sheet looks like. You can see the spike in their balance sheet following the financial crisis, all the rounds of QE that they did. They started trying to do QT, and then that ended with not QE in 2019. Obviously, the explosion in their balance sheet in 2020 and 2021. And yes, it went down for a couple of years, but ever since last year, their balance sheet has been headed higher again. And yet, despite the fact that their balance sheet today is way higher than it was 10 years ago, they actually own a smaller chunk of the national debt of treasuries compared to outstanding treasuries, which could be used as an excuse for bigger QE in the very near future. So the first thing we have to do to understand what's going on here is peel out the mortgage-backed securities. So this is the chart of the Federal Reserve's balance sheet if you're only looking at the mortgage-backed securities that they hold. And you can see ever since 2022, they've been systematically bleeding the mortgage-backed securities off of their balance sheet. They have now less than $2 trillion in mortgage-backed securities on their balance sheet, and that is not changing anytime soon. That is only going to continue to decrease. Federal Reserve has been very clear for years now. They have no plans to do anything but let all of the mortgage-backed securities bleed off of their balance sheet. They are not buying anymore. This is in direct contrast to the U.S. Treasuries that they hold. Even though they did sell off U.S. Treasuries for a couple of years, they've actually been buying U.S. Treasuries since the end of last year. And given the fact that their overall balance sheet level has been rising, it means that not only are they selling off mortgage-backed securities and taking all of that money and using that to roll over and buy new treasuries, but they're also buying more treasuries on top of that, which pushes up their total balance sheet level. However, something else has continued to go up without ever dropping, and that is the total national debt. This is the chart of all of the U.S. Treasury debt that the United States government has issued. You can see this chart only ever goes up and to the right, and we are now sitting at $39 trillion in national debt. And so while the Federal Reserve is increasing its holdings of U.S. Treasuries, we have to take a look at how many treasuries they own compared to all treasuries outstanding. Look at that over time, and that's exactly what I've done for you right here. So let's take a look. Hey, real quick, if you are an active investor and your portfolio is not growing as fast as you'd like, then I would like to give you a free gift. This is something I've been working on for a long time. My team and I put together a portfolio stress test. We looked at the top 6 risks that people are exposed to in their portfolios, many times without even knowing it. And most importantly, what you can do to fix it. So we built this really cool questionnaire quiz on my website where you can input all the information about your portfolio, your investing goals, and then it's going to spit out for you a customized blueprint that shows you where you're currently at and what you need to do to get to the next level. So no matter what is holding your portfolio back and no matter what risks you're exposed to, maybe without even knowing, I want to help you find and fix your vulnerabilities, again, completely free. Once you go through this little 1-minute questionnaire on my website, it's going to send you a customized blueprint to your email, PDF you can download and you can keep it forever. And that's going to give you access to all of my courses. I've created literally hundreds of hours worth of educational content that I used to sell for hundreds, sometimes even thousands of dollars. This is now my free gift to you. You can access it 100% completely free of charge. It's going to give you all the education, all the strategies and tactics that you need in order to fix your portfolio. All you need to do is go through the questionnaire, open up the email, save that PDF, and get to work. So if you'd like to take advantage of this, all you have to do is go to my website, heresy.financial/stress test. The link is in the description below as well. It's heresy.financial/stress test. Plug in your portfolio information, and I'll send you your custom blueprint 100% free. This is a chart that shows the percentage of the national debt that the Federal Reserve owns on its balance sheet. Of all the outstanding Treasury securities, back in 2002, they owned just under 10% of them on their balance sheet. That number trickled down, dipped down in 2008 and 2009 when the federal government borrowed a ton and exploded the debt. And then a bunch of that ended up on the Federal Reserve's balance sheet over the next couple of years. And they spiked above 10%, reaching 11% in July of 2011. Federal government kept on borrowing, and so it went down. But then in the next round of QE, it popped right back up again. And the Federal Reserve, now in 2015, owned 13, almost 14% of all the outstanding national debt. Now, if we take a look just at their balance sheet again, we can see that for the next couple of years, they were trying to not do any QE at all until 2019. And so what that looks like on their balance sheet is that they started to own a smaller and smaller chunk of the national debt, again, because the national debt kept on going up. And then it bottomed out just under 10%, which, if you remember, was kind of where it started back in 2002 when this data is available. And you can see that that's where it bottomed. And when not QE started in order to bail out the repo market in September of 2019, the Federal Reserve's share of the national debt exploded, all the money printing in 2020 and 2021. And then their balance sheet topped out at around 19% of the total national debt sat on the Federal Reserve's balance sheet by December of 2021. And since then, the national debt has continued to go up. The Federal Reserve has bled off their balance sheet up until recently, and they're sitting right now at 11.5%. So of all of the national debt, 11.5% of it sits on the Federal Reserve's balance sheet. Now, you may argue that that is too much. Some may argue that that is too little. And I would argue that the Federal Reserve is going to argue that it's not enough. Meaning, they want to make sure that they continue to own a consistent percentage of all outstanding U.S. Treasuries. That way, they're not influencing the Treasury market one way or the other. If they start to decrease the percentage of Treasuries that they own of all outstanding Treasuries, then that could put too much upward pressure on interest rates. Whereas if they start to increase that more and they go back up to, let's say 20%, maybe that puts too much pressure on interest rates moving lower. So they may argue very soon here that in order to make sure they're not influencing interest rates across the curve, that they need to target a specific percentage of all U.S. Treasuries. And it will probably be higher than 11.5%, maybe 13, maybe 14, maybe 15%, probably not as high as 20%. But you never know. However, there's another problem that the Federal Reserve is going to be facing here, and that is what kind of treasuries they own, because not all treasuries are created equal. We know there are 30-year treasuries, 20-year treasuries, 10-year, 5-year. We've even got bills as little as 4 weeks for maturity. And wouldn't you know it, the Federal Reserve has spoken about both of these problems in very recent history, as if they are preparing the public that they are about to do something about it. So the first problem, just the size. We can see that as recently as January of this year, they published a paper on the central bank balance sheet trilemma. Basically says of the three options, which is a small balance sheet, low volatility in short-term rates, and limited market intervention, they can only choose two. Kind of like if you're getting a construction project done, you can choose that the work is cheap, you can choose that the work is quick, you can choose that the work is high quality, but you cannot choose all three. Usually you can only choose two if you're lucky, but a lot of times only one. If you want it to be quick and high quality, definitely not going to be cheap. If you want it to be quick and cheap, definitely not going to be high quality. If you want it to be cheap and high quality, not going to be quick. It's going to take forever. And that's what's going on here. They can either choose a small balance sheet, low volatility of short-term interest rates, or limited market intervention. Now, over the last, 5 to 10 years before Kevin Warsh became the new Federal Reserve chairman, he talked a lot about wanting less intervention by the Federal Reserve in markets. In other words, he was saying a lot that he wanted option number 3, which means he can only choose one of either a small balance sheet or low volatility in short-term rates. And here's how I think they're going to solve this trilemma using the second part of what we just mentioned earlier, which is their balance sheet composition. 30 years, 20 years, 10 years, T-bills, how many of each type of treasury they own. That way they might be able to have their cake and eat it too, because they could have what they call a small balance sheet while maintaining low volatility and short-term rates. This right here is a chart that shows over time the maturity of the treasury securities held on the Federal Reserve's balance sheet. You can see back from 2013 to 2015, they held no T-bills at all, versus in 2023, they held a ton of T-bills. And right now, the long-term maturity treasuries that they own make up a much larger chunk than they did, let's say, back in 2022, or especially 2020. And many people at the Federal Reserve have pointed that and said that's a problem. Specifically, a speech last year by the Federal Reserve's Christopher Waller talking about the composition of their balance sheet. He suggests a maturity matching strategy where the Federal Reserve would match its holdings of Treasury maturities with whatever is on the open market, whatever is outstanding. This would mean that the Federal Reserve would hold about half of its Treasury securities in shorter dated bills. Right now, he says we have far too many long-term assets on our balance sheet relative for his arguments about how to structure the balance sheet. And these changes would mean having about 20% of the balance sheet in T-bills. And his argument for this structure is that if they did this, they would not be putting any pressure on any one segment of the yield curve. In other words, just like we talked about with the total number of treasuries that they own, wanting to make sure that it's commensurate with the total number of treasuries outstanding, so they're not putting undue pressure on all interest rates, they would need to do the same thing roughly with the maturities. Right now, they hold way more long-dated maturities compared to short-dated maturities relative to what is outstanding, which means when you take a look at long-term interest rates on 10, 20, 30-year treasuries, they are lower than what they would be if the Fed wasn't influencing it so much by holding so many of those. It also means that short-term yields are higher than they would be if the Fed held the proper percentage of those, which means that over the coming quarters, what we are very likely to see is the Federal Reserve's balance sheet overall continue to grow so that they can maintain a consistent percentage of outstanding treasury ownership. And it is also very possible that we continue to see a lot of that purchasing be done at the short end in order to make sure that they own the right mix so that their mix of treasuries matches what exists on the open market. Now, what they are unlikely to do, in my opinion, is accomplish this goal by selling long-term treasuries. That would push long-term interest rates higher. That would not accomplish the goals they are wanting to accomplish. And the biggest problem with that is there's nobody out there to buy those things, which means if that is the way they choose to handle this and try and solve their balance sheet trilemma by selling long-dated treasuries, it would most likely be accompanied with bank deregulation so that bank balance sheets would be unrestricted and could go on a buying binge, a lending binge to the US government like they did in 2020 and 2021. And absorb everything that was leaving the Fed's balance sheet. So maintaining the same percentage of national debt ownership, engaging in an Operation Twist, or at least changing what they are purchasing in order to match what is outstanding, and pairing that with bank deregulation might allow them to have their cake and eat it too. They could claim a small balance sheet even though it's growing because it is small relative to all outstanding national debt. It would maintain low volatility of short-term rates because they are buying at the short end, keeping those rates lower. And they would be able to say we are now limiting our market intervention because we are doing things according to a very systematized, pre-programmed method, and the banks are absorbing the rest. As always, we'll have to wait and see what happens. But if there's one thing you can bet on, is that when push comes to shove, the Fed's balance sheet will go up. It's a matter of when, not if. One last note, if you're an active investor and your portfolio is not growing as fast as you'd like, my team and I put together a completely free gift for you. It's called the Portfolio Stress Test. All you have to do is answer some questions about your portfolio and your investing goals, and then it will email you a custom blueprint that will help you fix the vulnerabilities in your portfolio that you maybe didn't even know were there. It's also going to give you access to all of my courses, hundreds of hours of education, strategies, tactics on investing and trading that you need in order to fix your portfolio. Again, this is all completely free stuff I used to charge a lot of money for. Your gift free. To access it, just go to heresy.financial/stress test. The link is in the description below. Fill out the questionnaire, plug in your information. I'll send you that custom blueprint. You can get started. As always, thank you so much for watching. Have a great day.